you test using the test one, nor use the other one.
Can you resend the other one?
It's already been sent. Hi, Ashley.
G'day, mate.
How are you?
Good, good.
Good. Thank you. Finally, we got a chance to meet you. Let me just make sure that I can get Dave to join in, and
Sure.
some attendees joining in as well.
No worries.
Just bear with me for a second. I'm just going to put it on mute before we have everyone starting. Can you hear me? Can you hear me all right?
Me? Clear as a bell.
Okay. That's good.
Got it.
Okay. So let's just wait a few minutes for people to start seeing people. We have Dave here. That's his EA.
Hello.
Hello.
Hi, I'm just the EA. Not Dave.
She's the youngest advisor in our team. So I think she holds the, I don't know whether it's a record official or not, to be the youngest financial advisor in the country. She's 19 and already a financial advisor.
Good for you. Good stuff.
We are preparing future home buyers, advisors for future home buyers rather than first home buyers.
Well, she's
Yeah.
probably in the right demographics.
Yes, yes. The Gen Z, the millennials are over.
That's right.
The Gen Z.
Cool, I'll grab Dave now.
Right.
Come on.
Where are you guys based? Well, you're in Auckland, obviously.
Yes, Epsom. We're in Epsom.
Okay.
Yeah. We have another office in Botany and soon one on the shore we're working towards. But the whole concept of having a physical office is changing slightly.
Absolutely.
So we're reviewing our strategy
It's
as
been
well.
accelerated, hasn't it, over the last little while?
It has, and it is. We were quite. We've always been quite flexible in terms of how we have operated, and if advisors are sitting in the office, then I think they're not being productive because
Yeah.
they should be out meeting customers, and that's what they enjoy.
Yeah.
So it is something that we have encouraged and given the flexibility, and which helps us get the right team in there as well. Because
It begs the question: what's going to happen to commercial office space around the country over the next 3 or 4 years as people start to not renew leases and look at their arrangements?
I know, and we think about that and think about these big behemoths such as WeWork and shared office spaces, which were, someone called them a petri dish of viruses. 'Cause-
That's true.
yeah.
Yeah.
And it's like, we at least in New Zealand are quite controlled, but imagine the word. So
The States or
Yes.
the UK, yeah, absolutely. Or anywhere in Europe, actually.
so that's Dave.
Hi, Ashley. How are you?
I'm good, mate. How are you?
Good, mate. Thank you so much for
Good,
joining
good.
us, and
Very welcome.
be great. Okay, good to see you, and will be good to hear a lot from you, a lot of your update and your
No
comments.
worries.
It's great. So we're just going to start bang on in 1 minute.
Yep.
We'll just give people an opportunity to join, and I can see already we have few people. So thanks to whoever has joined so far. And I'm going to cover how you can ask questions. There's a poll that I've created. I would love to know what people are thinking. What is the property sentiment out there from actual users? Because only God knows, I've read so much in the paper that I'm confused myself.
That's understandable.
Yep. Okay.
I've got the earphones, the wrong earphones.
Same.
Oh, man, too many earphones I've got. Oh, good, Ashley. You look like a film star on TV, mate.
That's all makeup, trust me.
It's all makeup.
What kind of makeup do you use? If I can get some of
I
your.
don't know. They get a really big brush and they just lather it on. So.
Me and they have been competing on beards, and unfortunately, I'm winning.
See, fortunately, I've got a bit more whiter, so I look a bit more,
Distinguished.
Distinguished.
yes,
Distinguished.
I've got
Very
the distinguishedness around me.
silver
Right.
fox, I think they call it.
Right. Anyways, it's 3 o'clock, so let's begin. Thanks for joining us, Ashley and Dave. So I'll start with the introductions, just discuss what the flow is going to be, how people can ask questions, and why we are actually doing this. So first, a bit about me, people who don't know me. My name is Yash Kapoor. I'm the COO for the Fundmaster brand. We are a very rapidly growing financial advice firm in New Zealand. We have few awards under our belt with Dave's hard work and effort that he has built this business up. A team of ex-bankers, young advisors who just want to meet customers and deal with them and help them getting into their first homes or build property portfolios and whatnot. Dave is the principal advisor, as I said, and he's the CEO of the business. And he'll introduce himself in 1 minute. And we have Ashley Church, who is, I think, a very, very well-known name if you read papers and newspapers and you read property news right now, who is a regular commentator on One Roof. You see Ashley attending breakfast shows and whatnot, commenting on property. He's been a CEO of Property Institute of New Zealand. Is that correct, Ashley, in the past?
That's correct, yeah.
And Ashley's been kind enough to spare some time to join our session to provide his input. I'll give a bit of context why we are doing this, and then I'll ask both the gentlemen to introduce themselves. So when we started doing these series, we thought there's still news coming at the rate of flash. Like there's no concept of hold the press now, and there's updates coming from banks. There's update coming from Reserve Bank. It's hard to keep track of. So a month or so ago, we decided to run live webinar sessions, Q&A sessions to keep our audience updated because there's only so many newsletters you can send. So ask your questions and you do that. The first one that we did, majority of the questions were around property market, that what the property market outlook is and what it's going to do. So we thought it would be a good idea to get someone who has a larger macro level sense of this topic, is the subject matter expert on this and can provide us with his thoughts. Now, that segues into that whatever we're going to discuss today is general discussion and general advice. This should not be considered as individual financial advice, whether regarding your finances or regarding your property. So if you have any questions for regarding that, you can always book a session with us, download our disclosure statement. And this is an opportunity to hear what's happening in the market and ask your questions. So I'll pass it on to Dave to introduce himself, and then to Ashley, and then we will start. And I'll advise how you can ask your questions.
Thank you. First of all, thank you, Yash, for moderating this and starting this. Thank you, Ashley, for being a distinguished guest, especially in today's post-COVID-19. We all get to see each other on screens. And I do see a lot of books behind you. That'll be great to see you in person and, talk about those books. One of them, if I could, catch hold of. But it's been great, Ashley. Again, I would thank you. Introduction-wise, I am they call me the founder, but me and my wife just thought of this name called the Fundmaster many years back, 2012, November. And from there on, the journey has been to make sure that get as many people in their houses, make sure that the bank's policy and their needs meet with the customer's needs, marry it up, and get them into the house and move on from one to the other to the other. This is what we do. As I said, Yash, I'm not going to speak much today because I do not want to waste a single word of mine because you got Ashley here. So Ashley, we're gonna have a lot of questions with you. And whatever words I can use to flatter you, I'm going to say on the pace that I'm going to flatter you.
It's working so far.
Is it? Okay. Right. So that's what I do. I'm a mortgage broker. I have to flatter you. Right. So moving on, Yash, I think our introduction, we can keep on, but let's focus on Ashley.
Sure.
And get more on Ashley and work and get more people to ask questions and see his outlook. And then
Sure.
we can update in the end about the market and what the banks are doing and the new updates.
Sure. So over to you, Ashley, if you want to introduce yourself, with a few lines, and then we'll jump into it.
Sure. So thanks, Yash. So in terms of an introduction, you gave a pretty good one. So my background in property goes back about 30 years. I was a property investor in the mid 80s when I was in my late teens and early 20s. And it was based in those days pretty much on the writings of Bob Jones and Ollie Newland, who
Yep.
are names that might be familiar to some people. And then I actually sold my portfolio in the late 80s for reasons that I still haven't entirely worked out. And didn't get back into the market until the early 2000s. But since that time, I've been pretty involved. Have been involved with a number of property organisations. I was the CEO of the Auckland Property Investors Association for a number of years. Property Institute, as Dev indicated before, had a property business of my own for a while. And I've become a commentator, I guess, almost by accident as a result of those roles. And so I think probably the thing I do bring to this, and the thing I'm probably quite keen to talk about today, is the historical aspects to the market and what we can learn from where the New Zealand market's been over the last 40 or 50 years, and what lessons that has for us in respect of what's happening right now with COVID-19.
Sure, that's great. Now, as we begin, whoever is joined in, on your screens, you would see a tab for Q&A. You can start asking your questions, whatever questions you have, obviously property and finance related. But we do have some that we have got very often, Ashley. I'll start with that. So the most obvious one, we're dealing with some unprecedented times. And so what's the outlook post COVID-19? Where is it heading?
So let me start by saying that nobody knows, and so anybody who has an opinion on this is expressing just an opinion, and I'm no different to anybody else. What I can do is I can give some indication of what's starting to be a growing consensus around what's likely to happen to the market. So what's interesting is if you look at the various different commentators, Tony Alexander, Cameron Bagri, some of the other well-known commentators in the market, and the banks, what we do know is that nobody is predicting a market crash. So there is no indication that the market's going to completely collapse. There are certainly some individuals who are saying that, but they're not commentators. They're not people whose opinion you would necessarily listen to. And so the worst case scenario I've heard from one of the banks, and I can't remember whether it was ANZ or ASB, it's one of them, was talking about a drop in values of between 10 and 15%, which I should stress is not a crash. And through to people like myself who are basically saying that with the exception of a couple of locations, places like Wanaka, Queenstown, perhaps Rotorua, that the market is likely to be flat, maybe in places like Auckland and some other metropolitan locations, a drop of maybe 5% for a short period of time. I think the other flip side of that is that nobody is suggesting that there's going to be sort of any sudden increase in house prices and property prices over the next little while. And there's a couple of reasons for that. One of them obviously is COVID-19, which is impacted. There was some heat in the market prior to COVID-19. Places like Auckland, where you wouldn't have expected there to be heat in the market until 2021, were already starting to take off again. That's gone. I think it's fair to say that's probably gone for a little while. And the other reason that market prices have flattened out a little bit, and it's got nothing to do with COVID-19, is there's a proven and established link between property markets and election years, which basically says that in the 5 or 6 months prior to an election, property markets in New Zealand flatten off until the election's gone, and then even for a couple of months after that until people have got to feel where the market's going. So for all of those reasons, I'm very much in the camp that says flat for the time being, certainly not a collapse, but also no massive increase in values.
Okay, that's good. So in terms of, we read about and we still see properties in central Auckland, and everyone possibly read that news, a property going 325K above CV in an auction.
Yeah.
So is there, as you mentioned, regional impact, countrywide, is there any Auckland-wide impact where you see that in certain areas where you see the impact to be more or less, or what are your thoughts there?
There are a couple of feeders which will, and that one incidentally, it's an interesting example, and it'll be interesting to see whether I'm wrong and that's a reflection of the market, or whether that's simply an outlier, and we won't know that for a little while. But there are some things that are holding the market up. But one of them is that the demand factors that were in place prior to COVID-19 are still there. And in addition to that, we've got two very big influences on the market. One of them is the Reserve Bank dropping of the LVRs. which basically means that we revert back to the situation that prevailed prior to 2013, which was that the banks made a decision on what the deposit could be. Now, some of your viewers may not know this, but prior to 2013, there were some banks that were allowing deposits of as little as 5%, or even in some cases, no deposit whatsoever. Now, I'm not suggesting that there'll be a quick return to that. In fact, I suspect it will take a little bit of time before the banks change their rules at all, simply because they're nervous about what's going to happen to the market themselves at the moment and won't be wanting to do anything quick. But once I think that they've got some confidence that the market's going to be holding up and there isn't going to be any major falls in price and house price values, then I think you'll see some competition in that space. So that's one really good feeder into the market for both investors and first-time buyers. And the other one is interest rates. So all of the talk prior to COVID-19 was, I think, that rates would stay low for a while, but that the inevitability was that they would start to go up again at some point, and they've dropped. So they've come down further. There's even some suggestion that they may go down a little bit further. I'm not brave enough to predict that, but I think it's fair to predict that they will stay where they are or lower for quite some considerable period of time. That's not just New Zealand, that's the world economy. So we're in a very benign environment when it comes to both deposits and to interest rates, and both of those will feed into what happens to the market. Incidentally, just before I finish that question, there's a reasonably established link between the dropping of interest rates, which has been a consistent phenomenon since the mid-1980s, which interest rates in this country have been slowly going down, and the increase in asset prices. So what that basically means is, as house prices have gone up, there's an argument that says that that's been at least partly as a reflection of the fact that interest rates have come down. And so if they're dropping further, that tends to indicate that will continue to fuel that.
Sure. Now, obviously that's been out there. LVR has changed and there was an answer. Is that reflecting through the bank's lending policies right now, Dave? Is that
sorry.
Let's say I'll start with Ashley first, and then then I'll pass it on to Dave. So Ashley, is that reflecting right now in banks' policies and in the market?
So I'll defer to Deb on this, except to say that I would anticipate the answer to that is no, simply because the banks will be nervous at the moment about what's going to happen to property values. But I'll be interested in Deb's response to that.
So basically, Ashley, what we've heard from sources that banks, you're exactly right in exactly what you've said. So far, I basically would say hands down what you've said is correct, and I would go with your opinion on that, and that's what I've been telling as well. But in terms of banks, we've been hearing. I've been trying to go in and try to find different information from different people. What we're hearing and what you'll hear next week is that two of the major banks are going to come back with a 20% deposit on investment property. So they will pass on that equity part, and 20% deposit will be okay for an investment property.
Wow.
Now, no bank apart from Kiwi Bank has announced it so far. Only Kiwi Bank is doing so. In Kiwi Bank, you can go 90% on owner-occupied and 80% on investment property, which you are well aware of. But there are banks, obviously it's not a policy which is out, so can't take the bank's names. But there is, which next week you'll hear, that 80% is coming on. But there are also another side of the news, which on owner-occupied properties, where they were doing 95% on brand new builds, is going to go away. They'll probably come to 85% to 90%. That's going to be the new way of looking into those properties. So that's what I've heard. The servicing calculation for different banks might change, might go lower. There is a bank which is indicating to launch it by next week. By next week, they should decrease their internal test rate, Ashley. So when they do the lending, you must be aware that they do on a test rate, which is internal, and then there is an external rate for all the customers.
Kev, that's interesting, the test rate, because you'll have a better idea of this than me, but my understanding is that test rate has been stubbornly high for the last few years. So it was introduced back when rates were around 5 or 6%, and it was around, from memory serves me correctly, it was about 7.5%. It was dropped a little bit last year, but it's still, so the gap between the actual rate and the test rate is huge. And so, as you say, there's plenty of room for them to review that and look at that, maybe bring that down. And that'll have an impact on people's ability to actually afford to borrow.
Exactly. And the banks are nervous. You see, the government could take the policy, change it around, but I always tell to my customers, and whenever I go out, I say that it's not the Reserve Bank which is lending money. It's the banks which have to make sure they look after their customers as well. Right? Because if the customers, let's say it's 0% deposit comes in, and if a customer doesn't even have a genuinity of save 5% of their deposit, how will you expect them to pay off the mortgage? So it's actually the right thing which the banks are doing by the customers in responsible lending, that people or the customers should be able to afford what they borrow.
It's a balance, isn't it, Deb? And I guess the
Yes.
argument for me, and I was a big critic of those LVRs for a long time, and my rationale for that wasn't that there shouldn't be care by the banks. My rationale was that there will be some situations where you've got people for all sorts of reasons who may not necessarily have accumulated a large deposit, but where you've got a couple, for example, who've got very, very good household incomes between them. And so are more than capable of actually servicing a loan. And so you're quite right. It's about where that balance is. Should it be more on the income and the ability to service, or more on the deposit, or a mixture of the two?
It's actually right. And the banks are doing more on, see, as per triple CFA, which was introduced a few years back, the customers should be able to afford what they're getting. And it's the bank's responsibility. If you go into 80s or even 90s and even 2013, 14, 15, equity, if you had equity in the property, you could get more money. The banks could give you that money. They could say, you could borrow more, keep a term deposit, and with a term deposit for a year's lending, they could give you money in those days.
I think the other frustration I have, Deb, and it's probably this is the thing that's been my mantra over the last couple of decades, is and one of the things that drives this is the fact that there's not a lot of understanding of the history of the market amongst Kiwis. If you go back, so we've got about 50 years of history of the New Zealand property market, going right back to the 1970s. And so the most important part of that's sort of from early in the 1980s. And we know from history that the New Zealand property market will roughly double in value roughly every 10 to 11 years. Now, there are some exceptions to that. There's places like Mackenzie, which went up miles home, but as a general rule. And so why that's important is because when we look at what the property market's doing, we can say that if it continues to do that, and the indications are that it will, that we can have some confidence about where it's going to go over the next 10, 15, 20 years. Now, the problem that we've got is that sometimes the people who are making the decisions on borrowing and lending within the banks, if I can be polite on this, are a bit younger, don't necessarily have that historical knowledge, don't know that, and so they're making their decisions based on short-term measures rather than understanding that history of the market. The flip side of that, of course, is that there may well be, the indication is that that's going to continue to happen, but it might not. We might have a massive great market crash in the next 5 or 6. I don't think that's going to happen, but this could be the one. This could be the different one that says, okay, it's going to go differently this time to what it's done in the past.
Exactly. That actually makes sense. And I also tell this to people that, people ask me this question, what is your take? Will the market go down? What should we do? We should buy or not? And I tell people, if you're buying to stay in the house, Auckland property market doubles in 10 years. You don't look into buying a property in terms of, sell in 6 months, then
that's right.
You take. But if you're buying to stay yourself, then forget the market, get into the house, pay your own mortgage, don't pay somebody else's mortgage. And 10 years time, your property, which you bought for 800 will be 1.6 million.
Good
if
advice.
all is good. Yeah.
Good advice.
Why not work around it? So that's why I'm saying that there's no doom and gloom. The problem is people think that coronavirus is a global economic crisis of doom and gloom. No, it's not. It's not a global economic crisis. It's something the whole world needed a break and a shake-up. Right? And the whole world has been given that shake-up, the lockdowns everywhere.
I think it's important. Sorry to interrupt you, mate. I think it's important to remember too that because most of the information we get on coronavirus, as indeed with any economic downturn, comes from media organisations for whom their greatest need is clickbait. It's about getting people to actually and sadly, and it's just a fact, bad news sells better than good. So a lot of the stuff that we're seeing in the media at the moment about just how terrible coronavirus is going to be, what it's going to do to the economy, the world's going to end, the chicken little the sky's going to fall. A lot of that comes from media looking for people who have those bad news stories. Now, that's not to say that sometimes those aren't right. I think that the predictions around Queenstown, for example, probably are accurate, and that's because of what's happening with the international tourism economy.
Exactly.
But in general terms, it'll be interesting to look back in 12 months and to see whether or not what actually happened was as bad as what some of the predictions were indicating it was going to be. And I'm talking about the rest of the economy now, not about the housing.
Exactly. And I agree with you. I mean, as you said previously, you said that Queenstown, Rotorua, and all these tourist destinations will suffer.
Yeah.
But remember, one thing which we have done in the world, you said bad news sells and all that.
Yeah.
One thing we've done in our present Prime Minister and all, one thing they've done is that they've brought attention of the whole world to New Zealand. And the moment our borders get opened, you will see an influx of people who would want to move to New Zealand because this country is able to control corona, this country is able to get a terrorist attack to go away. All those things would bring in. And what I personally think is in 12 months' time, as you said, in 12 months' time, we would go back and say last April was a shake-up of the world, but look at New Zealand economy, how it's booming, because a lot of people are swarming in. They would want to buy houses in Queenstown, Nelson, smaller towns, and even smaller towns like Palmerston North. Actually, a client of mine bought a property for 280 last year. It's worth 560 today in Palmerston North.
I've owned a house in Palmerston North. I had a house in Terrace Inn for a few years. It was a great little place. It's a very good place to invest in property. So I certainly wouldn't be criticising that. Incidentally, just on the tourism numbers, on the immigration numbers, you're quite right. The early indications already, for obvious reasons, are that there's a big increase in Kiwis returning home. So people who are perhaps in locations where they're a bit concerned about what might happen over the next few years are coming back home. So there's already that spike in those numbers.
Sure.
Exactly.
So that was my actually next question, that in terms of we may see a drop in migration from your skilled work categories, but there's a huge influx of expats returning. And I think you both have answered that that will have an impact, because generally they do come in with resources, a lot of knowledge, experience as well, and skills that they've acquired, high value skills that they've acquired that they can bring to the economy. And entrepreneurial skills from their learnings from overseas market that would boost the economy as well, and possibly an opportunity to rethink that we need to diversify as a country as well, rather than just being clean New Zealand and selling our scenic views, to what else we can do in terms of nurturing this talent and creating it whether a technology hub or a production hub or innovation hub, whatever that looks like. Now,
sorry, Yash, because actually, sorry, I was reading about all you last night as well, and all that. I was very intrigued, and it draws me more to you that you've been flamboyant and giving your opinion without anyone looking at it and saying that it's wrong or right, and you've made things happen. Newmarket, when you were doing that reverse thing in Newmarket, getting Newmarket back to honest. I used to work in ASB Bank in 277.
Oh, really? There you go.
I was a CSO then.
Oh, okay. How long ago was that?
2006.
Okay.
Right. So I was
Newmarket was a great role. It was as you the big change I think I brought there was they had focused, and I understand why they did it, but they'd focused so tightly on it being a fashion centre that they'd pretty much forgotten that in fact only about 600 of the businesses are retailers. The other 2,500 were actually businesses that you don't see. And so my big push was about focusing back on it being a business centre rather than just a retail centre. So interesting times.
Yeah, and probably when you were also involved in the city council roles out in.
I was very young. That was back in the 90s. In fact, I got stood for the Napier City Council in 1989. Got elected.
Youngest.
I think I was about 18 or something. I know.
You're the youngest.
What the hell were they thinking? And and then they re-elected me, and then re-elected me again 3 times. So
yeah, 3 times. Yes.
Yeah, I know. So I think after 3 times, I think they realised it was a mistake and they got rid of me. But in between that, I spent 9 years. So that was fascinating. That's normally the sort of thing you do as an old man at the end of your life. So it was a bit unusual to do that early, but I thoroughly enjoyed. Wouldn't do it again, but enjoyed it at the time.
Actually, there's a song. If you know "My Way," there's a famous song by Frank Sinatra.
I do.
So I would put that song on. I will put that song back to you. I would, when I was reading about you, I was just thinking about that song "My Way" and Frank Sinatra. I said I need to tell Ashley tomorrow that Frank Sinatra and the song goes on your head.
Yeah.
I think it's all done.
It's great.
On that, Ashley, on that reversing Auckland and also Napier, I know that people were not going there, and you got people back in as well. Going back to those days and drawing a parallel to today, don't you think that the New Zealand economy, looking at the property and all these things after Corona and everything, we would get back into those things by next year, because the economy, obviously, the expats are coming, people are going to invest. Immigration is going to go up. All these things are going to. This is also with Corona. I think there's another thing which comes out is it's make in New Zealand should come back. We've been
really interesting. I mean, implicit in that, Deb, is the question about what happens to regional economies and therefore regional property markets. And it's really interesting because 20 years on, very different country to what we were back in the 90s. So Napier, for example, in common with a whole lot of other regional centres around New Zealand back in those days, was actually trying to get people to move there. And I remember Napier City Council got an immigration consultant in, and they basically said to us, "You're killing yourselves because Canada, Australia, United States, United Kingdom, countries in Europe, they all want the same tourists. They're all competing for them, and those places have got much greater reasons for people to move there than they have got for New Zealand." We'll come back to 20 years, and the world's been turned on its head, because the thing that was against us back then, which was isolation, is now actually one of our greatest advantages. And that's pre-COVID. That goes back for about 5 or 6 years. And the reason that isolation is no longer an issue is because of primarily one thing: the internet. So the internet has completely transformed the world, not just in terms of people coming to New Zealand and going to Auckland, Wellington, or Christchurch, but saying, you know what, I can run my business from Palmerston. I can run it from Hawke's Bay. I can run it from New Plymouth. I can run it from South Canterbury or Dunedin. And so what that's done, and you can see it when you look at those figures of those property markets, it's given life to those markets where it didn't previously exist. So for somebody looking at investing in property, markets that you wouldn't have considered once because the capital growth was so slow are suddenly great places to invest.
Sure.
Yeah, that's what I think we would need. Your thinking back to rebuild New Zealand. I think Jacinda had to talk to you and me.
You might be the only person that thinks that, but okay.
No, I do like the risks part of it, because if you do not think outside the square, you don't take a risk. As you in the start of our commentary, you said that if anyone gives anything about the market, it's just an opinion, because nobody knows. Nobody's ever seen a corona scare ever. No. People could be 100 years old, they've gone, they've come, nobody has. So
1918, and I think none of us were alive then. So yeah.
Sorry, Yash, I'm going to go on. You carry on your question.
That's okay. Now I'm enjoying this to and fro, and I believe there's a lot of commonalities in terms of how both of you approach things, which is good to see. So you've answered a couple of questions already through your conversation. I have a very interesting one, and we divide our market into two key categories, which is your first-home buyers and your investors.
Yep.
So who do you see faring up well, and what would be the challenges for each of these categories?
So both, but for different reasons. So if I was a first-home buyer right now, it's a fantastic time. And in fact, in the next month or two, as the banks start to get a bit more realistic about deposits, it's going to be an amazing time. Low interest rates, potentially lower deposits, and a market where I don't think there's going to be any massive drops in house price values, but nor are we going to see the sorts of increases that we might have previously been seeing for a little while. So it's a very benign environment for a first-time buyer, but it's not going to stay that way. The LVR restrictions are going to go back on at some stage over the next 12 months. The Reserve Bank said they were only taking them off for a year. Interest rates are going to be low for a while. So that's going to continue, but house prices at some stage will start taking off again too. So if I was a first-time buyer who's been struggling to get into the market, I'd be dusting off my goals, and I'd be getting back into it right now. I'd be looking at what the opportunities are and doing everything I could. For investors, I don't think it's particularly one or the other, to be honest, but I don't think there's going to be huge bargains out there. Might be wrong. But apart from those locations we talked about before, I don't, any property investor who thinks they're going to sit back and sort of swoop on cheap houses, I think that's not going to happen. But nor is there going to be massive increases for a little while either. So the big thing for property investors is going to be, again, those LVRs, and as Dev's indicated, coming down to 20%, potentially even lower at some stage, and those low interest rates, which mean that their ability to make those property yields increases is better than it's been for a long time. So great environment for both of those. And the only real barriers, I think, are as they always are, it's just understanding the market and what's going on within regional locations.
And lending as well. I mean, I'll add on to it, Yash. It'll be important to add on what Ashley just said. It's dead right, because this is the time I tell people, and I'm telling everyone, if you have a dream to buy a house, it is the right time. But make sure you're saving enough money, because the bank for at least next 2 months are going to look at a lot of capacity.
Yep.
If your account conduct is good, you have got a savings ability, you've got a proven capacity that even after paying your rent, you're able to save some money towards a deposit. Well, those are the people who will be favored by the banks, plus your income. If you don't have income, then forget the dream of buying a house. Focus on your income, focus on your savings, and in next 1-2 months, specifically, I actually personally think after election, we will have the best Christmas ever, because November, December will be hot. It'll be hot in summer, it'll be hot everywhere. So we would see a lot of traction personally. And as first-time buyers, actually, I get this question all the time that we've heard that the market is going to go down. Should we buy now? I said every first-time buyer is thinking in the similar manner. That means you are the only people who are going to add to the competition, right? So if every first-time buyer is thinking the market is going down, let's buy now, that
Yeah.
means everybody's adding to the competition.
Yeah.
So why wait? Go in. If your approval is there, your affordability is there, jump on it, get an approval done, because you never know. The banks being nervous, if one bank in the next 2-3 weeks releases a policy which is a bit more conservative, all banks will follow. And
Yeah.
that's one thing which we, Ashley, you would, I'll ask you this question, that over the years from 80s and 90s and before, have you not noticed the trend between the banks that one bank does it and all the banks follow, and they try to play this game of market share, attraction, where one will say 2.69, other will come back to 2.69,
Yeah.
2.65. I
Yeah.
mean, there's something like, a child's play, 4 kids on a street.
I agree. Although I would also say that if you go back to the 80s and then flick forward to now, that trend's all been in the right direction. And I remember in the 80s when interest rates were over 20%. Mortgage interest rates were over 20%. It was a terrible time. Although you could still buy a property and and it could still be positively geared. So the market was quite different. One of the things that has changed, and I agree with you that the banks play this sort of Simon Says thing of all being the same. But the other thing that's changed is that because one of the comments I get from people when we talk about the property stuff is I always get people saying, oh, it's going to crash this time, and then they'll give me the reasons why it's going to crash. So they'll give me this particular set of things. So at the moment, for example, it's coronavirus.
Yeah.
What's interesting about the markets of those 4 property booms over those 4 decades is that with the exception of interest rates, which have come down consistently over that period of time, each of those 4 cycles has had entirely different things underpinning them. So what do I mean by that? If you look at the 80s, very high interest rates, very high inflation, very low immigration, doubling in house prices. Go to the 90s, we had interest rates coming down a little bit, inflation coming down a little bit, still pretty static in immigration, doubling in house prices. We go forward to the 2000s, we had lower interest rates, lower inflation, we were starting to increase immigration, doubling in house prices. What's my point? Is that there isn't a set of common factors that actually underpin the market to say this is why the market's doubled. Why is that important? It's important because if you take that as a guide to what's going to happen to the market, then all of the things that are happening at the moment economically, whether it be COVID or anything that the government's doing or rule changes, won't actually affect the long-term run of the market, because the indication of the history is that it does what it does regardless of what else is going on. And that's a really important thing to understand.
It's really good, because that is the reality. People try to pin down factors.
Yeah.
Well, there's no factor, because it's such a changing environment.
Yeah.
That if what we are talking about and the market change, immigration happens,
Yep.
expats come back, you would see a double up of the economy anyways, or the market
right.
property price will go up.
The one caveat to put on that is they can have an impact in the moment. And what I mean by that is there can be a government change which affects the market for 6 months. But over the 10 years, because it's 10 years we're looking at, the market does what the market does.
True.
Actually raises another question too, Yash, which you might have
Yes.
as amongst your questions, and that is what's going to happen to the market in the medium term. So if there'd been no COVID crisis, and I was getting this question a lot late last year and early this year, was where's the market going to go? So what traditionally happens is the Auckland market is generally a little bit ahead of the rest of the country. So the Auckland market goes into a boom earlier than the rest of the country. The rest of the country is about 2 to 3 years later. And the Auckland market comes out of a boom earlier than the rest of the country, and the rest of the country carries on and then comes down. And we were actually seeing that playing out exactly as you would expect. The Auckland market came off the boil about 2018, and the rest of the country was still going strong. We were still getting really positive house price growth in most of the rest of the country up until just before COVID. The question is what's going to happen going forward? Does that change? So normally you would have said that the Auckland market will start to pick up again sometime during 2021, and it would go into another long run boom of about 6 or 7 years if it followed the tradition of what's happened over the previous cycles.
Yep.
Whether that will still be the case, don't know. My guess is it probably will, for the reasons that I just put forward before, which is that over the long term of the market, it does what it does. GFC was huge when it came along. Actually, it didn't affect the 10-year cycle overall. The Asian financial crisis in the 90s, it was big at the time, didn't affect the long run of the market overall. If that's going to be the case now, then COVID-19 will have a bit of an impact right now, but it won't impact what happens to the market in the 10-year period, which that market will be subjected to. So that's an opinion, but it'll be interesting to see if that plays out. I'll be interested in your view on that, Deb.
I would work with your view. My personal thought process was that the market after elections is going to pick up.
Yep.
It's going to go well, and then once the Reserve Bank puts their brakes on,
Back
then
up
we'll have a
again.
bit of a slowdown. Once we start readjusting to the system, it goes back up. Now, if I take you back 6 months, the Reserve Bank brakes were still on.
Yep.
But the banks were still lending 95% on brand new properties, which will be a problem now.
Yep.
And that's what I'm saying, that even though people were thinking that there was no low deposit lending, but there was a lot of low deposit lending. Yes, it had a quota of 20% of the bank's overall lending book, but that was enough to lend people money with a mix of brand new houses and
Yep.
a bit of old houses.
Yep.
And because of that, people were buying a lot of brand new houses. So the market, in fact, you would have seen February numbers. And if you look at from December 2019, Jan is a bit of a slow anyways.
Yep.
But the bank's approvals and our inquiry rates were high.
Yep.
Right. And the bank said they had the best December in approvals. They had the best February, with the biggest February for ANZ Bank. What I'm saying is that these things were happening with that rules which were already in place.
Yep.
So if people have that opinion of LVR restrictions, oh, the moon is going to come out, the sun is going to come out now, well, that's not going to be the case, because banks will be nervous and they will try to impin new policies because they've got a more free hand.
There's another factor which comes into play there too. So for several years, I've been battering the Reserve Bank about the LVR restrictions and talking about how they were closing people out of the market, which I still believe. I'm still very much of the view that they were having an impact. But Velocity, who are an organisation I get data from, came out with some figures about a year ago, which were interesting, and they basically showed that even with the LVR restrictions, first home buyers were actually the biggest single group of buyers in every market in the country except, and this was the caveat, except Auckland. And the reason that they weren't the biggest group in Auckland was because house prices in Auckland are so much higher than they are in other parts of the country. So coming up with a 20%, if it was 20%, although you're right, if they bought you, it could be 10 or 5. But coming up with a 20% to buy a villa in Ellerslie at $1 million or $800,000 in Auckland was a much more difficult proposition for Auckland first-home buyers than for somebody who was buying a property worth $300,000 or $400,000 in one of the regional cities around the country, and that was the difference.
Exactly. And Hamilton, I've seen an exponential part in Hamilton, right? I mean, I did loans 2 years back or last year for customers in Rototuna and Flagstaff, all the new areas, and they've doubled. They
Yes.
doubled in 2 years.
Yes.
And that was just crazy. And when I drove past Hamilton a few months back, and I saw the houses in the development and the boutique houses which are built there,
Yep.
it was just amazing. You could not, why would people not move there, get a property on a lesser price,
Yep.
rather than having double the same property, double the price in Auckland?
Yeah.
Well, you could do business anywhere. Yeah.
So
So-
that
Yeah,
brings-
I'm conscious that we've been chatting away without listening to your questions.
No, this is the most natural moderation that I've done, because you guys are preempting my questions that I need to
Right.
ask and answering that already. So this is I actually would encourage, so two things, whoever is listening to us, if you have any questions, if Ashley and Dave haven't already answered yours, feel free to ask them. And we've also created a poll that we are talking about, that this is what the input is, but we want to hear from you that what are the actual individuals thinking on the street. How are you feeling about? So there's a property sentiment poll that I've created. Pass on your views, that what do you think? There are 4 options that you will see that prices will go down more than 10%, as one of the banks predicted. The other option is will go down slightly, but then they will bounce back quickly, as we've been discussing. Will stay as it is, or prices will increase. So whatever you feel, I'm just going to launch the poll now, and then you can think that what your opinion is, and we would love to hear that. If you have any questions, do ask them right now. I'll be more than happy to present them to Ashley and Dave. But I have a question, which is 2 questions actually. One is, you guys both mentioned that the obviously the new developments have fared quite well. Examples of Flagstaff, Rototuna, and you can say Flatbush around in Auckland. How does, with this LVR restrictions gone, the impact on the construction sector is going to be? Because people have this existing stock of houses that suddenly has opened up to them. And there's a lot of development lending that has been done. Does that make a competitive opportunity for buyers to get in and negotiate with those developers and get those new houses?
I'll give my thoughts on that, and then Dev will probably have a view on that as well. So in terms of the construction sector in general, so I'm aware that there was already some nervousness prior to COVID-19 around development, particularly in Auckland, and that in fact some banks had even pulled their funding on some larger projects, and of course that actually then causes a tightening of supply, which in theory causes an increase in overall prices. I don't think that's going to get any better for a little while. I think in fact if anything it's probably likely to get worse, in that the banks will now be even more nervous about what's likely to happen to property values, and therefore will be looking to have some more confidence in the market. I also understand, and Deb, you'll have a better idea on this than I will, but the requirement on developers to have a number of these units pre-sold before they actually turn soil has increased. So the banks are basically saying, we actually want to know you've sold a substantial number of those units before we actually, before you turn sod, basically, before we're prepared to fund. And I suspect that that's likely to get even a little bit more rigorous to start with. But I do think that once the market starts to show that it's okay, and that people are still buying it, that for all the reasons that we talked about before, you'll see that reverse, and the banks will start being more active in that space. But Deb, I'd be very keen on your view on that.
In terms of development lending, and Yash, the question which you asked, this has been asked a lot because there's a lot of stock which is opening up. Once the LVR restrictions are gone, banks start lending up to 85-90% on first-term buyers, and they can use the equity to buy another property. There will be a lot of changes in terms of stock. People who were actually blocked to buy bigger pieces of land with the house, who were only able to, or who were only left to buy a new property, will now be looking to buy big pieces of land. Because everybody, before LVR restrictions and all these things, there's a big change happened in the Auckland City Council. Actually, you would, agree on that when we got those changes on the Unitary plan, and every land was subdividable, and everybody wanted to be a developer.
Yep.
Right? This is something which I feel and see a lot, that everybody wants to buy a piece of land and put two houses at the back. Well, that's a dream that everybody wants to have, but does the bank want to lend the money on it? Now, the bank doesn't want to, because the banks are getting nervous again that people who have no experience on building might go custard with their developments, because they might have wrong builders, they might have wrong circumstances, or just hands to mouth in terms of construction. So the banks are nervous around that fact.
Yeah, so just for people who don't understand what we're talking about there, so the Auckland Unitary plan, which was put together over 4 or 5 years after the Auckland Super City was created, basically came out with this mantra that talked about what they called up and out. And so out meant the city growing larger, but up meant more intensification, more apartments, more basically opportunity to build high intensity housing where it hasn't previously existed. And so Dev's quite right. I think people either thought that the opportunity to do that themselves, or to parcel up their land for a developer who might want to buy it as part of the larger package, was going to be sort of man up heaven and an opportunity to make a fortune. And it hasn't quite played out that way for a number of reasons, partly because, as you say, of the nervousness of the banks, and partly I think because people are still coming to terms with what that actually means, and it's probably going to take a decade before we see what that really looks like. So yeah, interesting times. The mum and dad thing, where you've got a section in Panmure that you bought, a house that you bought 20 years ago, and it's got a massive great section at the back, the opportunity to subdivide that, I think that's still there. But the banks are going to want to know what the plans for are beyond just simply carving that piece of land off, and in terms of what you propose to do with that.
Yeah, and anything, just there's another thing, anything when the bank hears about development, they talk about going to property finance unit. And property finance units rules are completely different to normal lending. Normal lending of, I'll have another house, I'll stay in that. But if you go anything more than 3, they have stringent policies. They want a QS report. QS is a quantity survey, which is an expensive report to have. Then they want pre-sales to an amount where the loan gets finished. It should be unconditional. Now, in this piece, a lot of second tier and third tier markets had opened up. The likes of First Mortgage Trust, ASAP Finance, these second tier lenders who've been still backed by the banks have opened up and made a lot of money in terms of higher interest rates and fees because the risk is higher. But they have also stopped lending till June or July with my discussions on them, because they're nervous of the fact that if the value of the property was 800 and goes to 650, then they lose money. But if it's only 780, so they want to see how post-COVID situation happens, that if people are able to retain the property value, as Ashley said, the property market will stay. If that happens, I see that in July, the development funding will be more done by second tier, not by the major banks. because the major banks are slow to open funding. They'll open it for the first home buyers and smallish investors, mom and dads, and then they'll move on to the bigger ones eventually. I don't know when, but we will have we will have a lot more. In a sense, there will be difficulty for developments, but if it's second tier and they're happy to pay higher fees and still make profit, then it might be a reality for them.
Sure. So to summarize that, what it means is that there may be opportunities. It was already an exciting space for first home buyers and investors. It may be an opportunity where builders are and developers are wanting to complete those pre-sales, and an exciting opportunity for people to secure some good buying opportunities here in the return, because if there is a high level of certainty that bank is looking for, the only way to do that is to sell something at a good price.
Yes.
Now we have a few questions coming in now. I'll ask the first one. So, and that was my planned question as well. So what do you think about the commercial property market in the near future? And actually, before the webinar began, we chat about that. So I'll pass it on to you first, and then I would love to know your input, Dave, as well.
Yeah, so very quick answer to that, to the implied question there, and that is I don't know, and I don't regard myself as a specialist on commercial, so I would be very wary as a viewer of this to take too much notice of what I say when it comes to commercial property. The only comment I'd make with regard to as a layman is that it will be interesting to see what COVID-19 and the change in people's work habits and working from home does to the market over the medium term. So when leases start expiring over the next 3 or 4 years, where the businesses say, you know what, we can actually work remotely, or we can have our staff working remotely, we don't actually need an office. Now, again, I don't know whether that's the case. I know in terms of a business that I'm involved with, that's certainly a question we're asking at the moment. Whether that has an impact on the commercial property market overall, time will tell.
Yeah,
sure.
I'll just add on to Ashley there. Ashley, in commercial property, what I've seen and what I was seeing last year as well, that some banks have closed shops for investment commercial.
Right.
They were looking to do owner occupied, especially
Yep.
BNZ Bank, right?
Yep.
I'll just name a bank here. But in the recent past, post COVID-19, well, the banks still haven't opened a lot of their doors.
Right.
And a lot of their teams will be sitting in different A, B teams, where some people will come to office and some will work from home, because COVID-19 had made people realize one thing, that you could be efficient even sitting at home. I don't believe it in personally. Just
that's
I am an office
the
guy.
continuous tussle that we have. That
yeah, the jury's out.
The jury's out on there. That's an internal thing we keep on carrying.
And yet here we are using this. So
we are using this. So.
Yeah, but actually, I'm still tempted to come sit with you and read. I take a book from you. So I'm going to still do that. So on that note, commercial property space. In my discussion with another commercial senior manager in one of the banks, exactly the same thing. Banks are doing a lot of their internal ratings in terms of risk rating on property. If the high risk property, and if it's more investments, they are going to bit shy down from it, because investment properties, as Ashley rightly pointed out, that people who wanted to go have high offices and put people in there would now let them sit at home. So investment offices and all those properties will have a bit of a shake. So banks are aware of that and they're nervous around that part. The second bit is the banks will be more keen for owner-occupied properties, where the individual people who are owning the property and the kind of business they're running from there, how stable is that? Because at the end of the day, the banks, for people who don't know, banks only lend up to 65% on a commercial property. There are certain banks who can do up to 80% as well, where the 15% extra they put through is given as only for owner-occupied buildings, and is given as somewhere where it's a short-term 5-year loan amortized over 5 years. Right? So the banks were doing that. But in coming times, commercial properties will be a bit harder to get funding on. So you'll see a lot of competition in terms of a lot of opportunity for cash buyers to go in and put their money, as per me. It's a personal opinion again. But yeah, there will be lending breaks on that from the bank side.
Sure.
I think that probably the one key thing, which probably summarizes all of that, and even for somebody like me who's a layman when it comes to commercial, is that we're going through a fundamental societal change, and we don't know what that's going to look like.
Exactly. Perfect.
Yeah, that's great. Now, I have another question, which is, I'm going to read this out, and let's see if we can figure this out. With the LVR only being lifted for 12 months or so, is there any real benefit for an investor, as once re-established the LVR restriction, the banks will be wanting to claw those low deposits back with principal and interest. I'll pass it on to you, Dave, first, because it's an LVR related, finance related question. So is that something banks will do if the LVR restriction is taken off? Can they claw back equity?
No,
What are your
basically
thoughts?
it's not, they don't claw back equity. So I would just go back on that question. Basically what happens is that yes, the LVR restrictions are taken, but the person who asked us this question, we just mentioned about the fact that even before the LVR restrictions, the market was hot. People were buying properties. Yes, it was more towards older properties were being bought by investors who would develop, subdivide, and newer properties were bought by the first-time buyers who were not able to subdivide, but wanted a comfort or a house or a roof, and they wanted just to be in the property ladder, right? In that case as well, when before the LVR restrictions came in, the banks didn't claw back lending, but when you go for a new lending, then they overall put your LVR ratios for the overall portfolio, and then they lend you money. For example, if you had $1 million property and you were lent 800,000 and the restrictions were 70%, they will not say, okay, give us 100,000 back.
Yeah.
But they will say, next time you come to us, we would make sure that you have enough equity to borrow more, otherwise stay put wherever you are, but they don't go back. So,
and in fact, I'd reinforce all of that, but I'd add to that in fact, if anything, the taking of the LVRs off or lowering them for investors at the moment is a reason to do it now rather than wait. Because if you wait, then that's going to be applied across so you may not even be in a position where you can lend anymore, whereas you may be able to right now. Hey, the other thing which is implicit in that question, it wasn't a part of the question, but I do want to comment on it, was this whole question of interest only versus interest in principle. And so if you buy into my mantra, which is that property values double in value roughly every 10 years, I've always had the view, and I'll express it again, Dev might have a different view, you would absolutely have to be crazy to ever pay principal on your loan. You would pay interest only, and when the bank says to you, okay, we now want you to convert the principal, you'd churn the loan, take it to somebody who's prepared to do it interest only. I cannot get my head around why anybody would ever pay principal on property in a market where capital growth is so predictable. But Dev, you might have a different view on that.
I totally agree with you. Hands down, totally agree with you, because you won't imagine, I tell this to all my customers. I said leverage is the word. Yep. Leverage your equities. If you can pay principal on an owner-occupied property.
Sure.
Knock it off and keep your maximum lending against your investment properties, because that's the way historically has been done, as whatever I've studied, whoever investor I've met. And churning part, I mean, and brokers are not allowed to say that word, but you said it, so.
Hey, let me give you an example too. I mean, I understand the argument for paying on owner-occupied, but I can even advance an argument there, and I'll give you an example.
Okay.
My mum and dad built a house in 1970 in Napier, and they paid $30,000 for a brand new home. They built it for 30 grand. And she would have paid, well, she did. She paid principal and interest because you did in those days, and so she struggled to pay the principal as well. If she paid interest only, and to be fair, that may not have even been an option, but if she paid interest only for the 40 or so years beyond that until she sold it, when she'd come to sell, and I think it sold for $500,000, she could have paid that 30 grand off out of the proceeds of the sale and still pocketed 470. Why you would pay, and in dollars that were inflation adjusted, why you would have actually paid principal at the time is beyond. However,
exactly. Well, actually, I would agree on that. But triple CFA, when was launched, the banks were very pedantic that owner-occupied properties, you can't go interest only. There's only one bank in the country which allows up to 3 years, which is Westpac, to go interest only on an owner-occupied property with reasons. But there's a way, if you portfolio all the loans against investment properties and keep nil against yours, that's the way not to pay principal. And I totally agree with you. If you could do so, principal payment should be left in, because your mantra of 10 years is dead right. That's the best thing which has happened in our market, will happen in our market. And it
runs counter, incidentally, Deb. It runs counter to everything that Kiwis are taught from the moment they're born, which is pay your mortgage off, pay your mortgage off. That's completely counterintuitive, but it makes sense.
Paying your mortgage off. I mean, I personally tell to all my clients, I said, what will you get? You'll have a star here that you paid your mortgage off, then what?
Yeah.
Right, rather than leverage, get more, move on further, build a portfolio. And if you can build a portfolio, sell a few when the market is double, 10 years, pay off your loan, have those properties, pay off your retirement, make you happy at the time.
We're on the same page. We're absolutely on the same page.
let me reiterate again. So if you want this to be a personalized session, we encourage you to book a meeting with one of our advisors, download our disclosure statement. I bear the responsibility of compliance for this business as well. So as you would imagine, Well, I am
Sorry,
being
guys.
no, no, that's all good. It's as I disclosed earlier on. It is general advice. We do not know what individual circumstances are. This
Mm,
may suit some people. This may not suit some people. But this is something that we suggest to our customers who are on this pathway of building a
Investments.
portfolio and investments and everything.
And there's
sure.
Each
another thing. Sorry,
yeah,
sorry, yes, carry on.
sorry. So each individual has their own preferences in how they want to run and how they want to live. So the circumstances we review, and that's when we advise. Now, guys, I understand that you both are on the same topic, and we love to chat. There's two more questions that have come up, and then I'll just go through. I'm just mindful of time
Sure.
for everyone, and if there's an opportunity to do this again, we'll possibly do this again and get you both in a room when level one comes and broadcast it to a wider audience. But two more questions. I think we've answered this, but I'll rehash this. I'm planning to buy a house. Is it the right time for first home buyers? So I'll answer this for if I can get the opportunity. So Kaushal, yes, we have discussed this. There is definite opportunities in the market right now for first home buyers, provided you have your capacity is there, it all stacks up, and you can get in because the LV restrictions and the interest rates are low. So financially and where the market sits, it does make sense. And because of the changes in the LVR, do you think lending criteria will be relaxed? And if yes, when can we exactly notice that it happens? Dave, I'll quickly give this to you for 2 minutes because the question is when this would happen. We don't know, and you manage the banking relationships for us. So I'll pass this on to you, and then I'll announce the results of the poll as well.
Yeah. So the lending criteria wise, the banks are coming with changes, even though they will relax the servicing rates. But internally, the banks have the capacity and the capability to have certain minimum surpluses they want on every kind of application. So as and when the loan to value ratio, let's say you're at 90%, they would want a higher surplus. Vis-a-vis if you're at 20% or 30%, they'd want a lower surplus. So it depends on an individual to individual basis. Yes, the banks will pose to relax, but on the hindsight, they will make it tougher as well because they want to make sure that anyone who buys the property are able to service debt and pay it off because of triple CFA and banks personal responsible lending and all that. So that will happen.
Sure. So thanks a lot for that. And I'm just going to go through the poll. Now, a lot of people have answered. 95% of the people who have attended have answered. So only 4% of the people agree that the prices will go down more than 10%. 70% of the people believe that will go down slightly, but they will bounce back quickly, which is logical. So what we have heard will stay as it is. 9% of the audience, and 17%, which is very exciting to see, prices will increase. So the optimists in the audience believe that the prices will go up. Well, I believe if that happens, and that will be aligned with economic recovery, which we all want, and which would be very exciting to see. Now we've reached a stage as a country where we only have one live case, which is very exciting. Collectively, what we have done as a country is quite commendable, and we've all stuck. There's always going to be issues, but um, word is looking at us at very optimistically and very positively, so which is quite impressive to see. So I would say we only have 1 minute, 2 minutes left. I'll thank Ashley again for your input, your knowledge, and your agreement to spare your time for joining this session with us. For people who haven't been able to join, we've recorded the session. We'll make this available to you. We'll share this, and Ashley would have the session as well if Ashley wants to share it with any commentary where you see this useful. And thank you, Dave, for we've been doing this very regularly, and I think rather than you bouncing ideas of me, you finally met someone who thinks like you and has the same level of optimism, which is good. It's just quite exciting to see. I don't know why I was here. Yeah, so that's been quite good. Thank you, guys. We're finishing bang on time, and
Good stuff. Thanks,
we
guys. It was good fun.
really
Ashley, thank you
appreciate it.
so much, Ashley. I would just take this opportunity. We should probably do it often. See you, get you out and get people to listen to your commentary. But it was great to, hear that somebody is thinking like that. And I would one thing I tell all my customers. Actually, you would have seen it as well, that people are nervous to buy a second, third property, especially a lot of Kiwis. And I've been telling them, don't be nervous if you've got good incomes, if you've got safe, keep some, in our New Zealand market, next time, Yash, we could take it a topic with Ashley, is that, we could have revolving credits
Yep.
or offset mortgages.
Yep.
It's a blessing in disguise.
Absolutely. 40 years of history that tells us it's a good thing to do.
It's a blessing in disguise, and
Yeah.
it helps so many customers. And all our customers, actually, we do a budget planning with them. We help them do a budget and savings for 12 months goal.
Yep.
People who saved money and listened did not go on a mortgage holiday, right?
No.
And one thing which COVID-19 has taught you all is that make sure that 10% of your net earnings are stashed away into an account,
Yep.
which should be reinvested every year.
Yeah.
Every year. And that's what we want to leave everyone with. And Ashley, if you would like to add 2 cents of your stuff there, because I would speak with you for hours and hours, mate. I mean, I just feel like not going away from the screen. I feel like, going and banging. Yash, why are you closing it at 4 o'clock? But actually, I leave it with you.
I just agree with everything you've said. Love your enthusiasm. I pretty much agree with everything you've just said. It's a good time.
That's
Thank
great.
you.
Thanks, everyone. And thanks, everyone, for joining and spending the time on a Friday. Have a good, nice weekend. Stay safe out there. If you're heading after a very, you can say, prolonged period, heading out of town, stay safe out there. And be careful and enjoy a long weekend.
Thank
Thanks,
you.
guys.
Thank you. Thank you,
Cheers.
Yash. Thank you, Ashley. Cheers.
Bye.
Bye.